It's good to see you again. I am Joe Gallimore, Director of Investment Management with Argent Bridge Advisors, and welcome back to another Cup of Joe. So during the month of April, markets were very mixed. The S&P 500, the EFI International Composite, and the U.S. Aggregate Bond Index were all positive. But we saw riskier asset classes such as U.S. mid-cap and small-cap stocks and emerging market stocks. Those were all negative during April. So what led to this very mixed performance of asset classes? Well, we saw continued uncertainty in the banking sector, as I'm sure you all heard, and this led to a decidedly risk-off tone among retail investors. And as a consequence of that, we all saw significant flows out of banks and into bank deposits and into money market funds as the fallout from the small regional banking troubles persisted. There was also the message from the Federal Reserve where they were bolstering their intended policy of hiking interest rates. That kept a lid on things. Their tone was hawkish, as they say, and they are going to stick to it until they see a meaningful reversal in inflation and wage growth. Now, this reversal has begun in earnest, but the economy is proving very resilient, and this means that the data that the Fed is watching still remains too good for them to stop raising lending rates. So, as of the end of April, the S&P 500 was up 9.2%. EFI International stocks, that had a very good April and now stands at just under 12% for the year. And the U.S. Aggregate Bond Index is chugging along, but is positive 3.6% for the year, and is also paying more income now along the way. So that's what's going on in markets, but we at Argent Bridge wanted to address a question we're getting a lot right now, which is the debt ceiling and a potential showdown in Washington regarding raising the debt ceiling and what could happen, or what could happen if it gets to that deadline and there's impasse. So first, we want to say that this is not an unprecedented event, and these debates coming close to the limit, this has happened many times before. But it's a fact that the U.S. has never defaulted on its debt. And no professional that I've heard recently, and I've listened to a lot, none of them think that the U.S., there's even a remote chance of the U.S. government defaulting on its debt. So in addition to that, they all think that the chance of them even not extending the debt limit is also extremely low. So we're about to discuss a incident that has a very low percentage chance of happening, in our opinion, and that's the consensus opinion from what we're hearing. But of course, nothing is impossible. And for full transparency, we wanted to briefly address some potential conditions if push does come to shove in this situation. So the scenarios for a standoff. First of all, you should expect some volatility in bonds between now and then. No matter what happens, if they figure out a compromise way before the debt deadline, or if things creep further and further up to the deadline, expect some volatility in bonds. So your expectation is there, and it won't be a surprise. Now, if a standoff results in a downgrade for U.S. government debt, you will see some volatility in the bond market, and you may even see a price shock in bond funds. But this should settle down relatively quickly, we think. This is what happened back in 2013, if you remember, when the S&P downgraded U.S. debt one notch, and then shortly thereafter raised it back up. Now, in the event that there's a technical default, which is not a missed payment, but a delayed payment, it'll be the same as if there's a downgrade. You're going to see volatility in bonds and a price shock in bond funds that will probably be a bit more than if there's simply just a downgrade. Now, the team here at Argent Bridge also wants to point out a few things to put this all in perspective. Some of this may be akin to a self-fulfilling prophecy. Some of the danger or the volatility that we're worried about in this scenario is actually due to headline risk. Investors worrying about this potential problem and them taking small just in case actions actually adds to the volatility that we're worried about. So it's kind of a frenzy mentality. So there's headline risk involved with this showdown, even if there's a compromise in Congress. This issue that we're talking about, it's important to remember that this is all within people's control. This is a self-imposed debt limit that can be raised or even removed by the actions of Congress. This is not inflation or corporate profits or some other, sort of invisible market force that has to react by itself and no one knows what's controlling it. This is a known issue and it has a very clear mechanism for fixing it. Thinking about Congress for all their hot air and saber rattling, as one of our astute clients put it, Congress knows the damage and the severe damage this could potentially cause if they let this thing get out of control. And I think we should all believe that they're simply not willing to let that happen. So it's an issue that is within humans' control. It's never happened to the point where a default has happened. And the experience we're going through right now, which is the buildup to this showdown, it's happened many times before. So let's lean on history on this one. But in these, uncertain times with the debt ceiling debate, with looming recession, all these things, we wanted to let you know what we here at Argent Bridge are doing for you behind the scenes. We're setting aside cash as volatility continues this year, and we expect volatility to continue. So for clients, say in distribution mode or in portfolios or coming up with anticipated expenses, we're setting that cash aside now so it doesn't experience volatility being invested. Also, we're using more CDs and treasuries and money market funds as short-term savings vehicles because they are providing some very nice income now with very minimal risk. So we're incorporating a lot of those. As we have in the past, for any cash that is intended to be invested for the long term, we're using what's called dollar cost averaging, where we're putting little chunks of cash to work at different times. So if there is volatility, we're capturing those price dips as we're investing. And our investment committee here on the team, we've been meeting frequently to monitor accounts and our portfolio models and to see if there's any opportunities where we can be rebalancing at some opportune times. We've adjusted stock exposures in portfolios a little bit to lean into areas that will actually weather recessions better as the chance of recession, becomes elevated. And the advisors that you meet with regularly, they're paying very close attention to debt management on your net worth statements because we all know borrowing costs have gone way up in the past year, 15 months, and they're paying close attention to that item on your net worth. And we're also, all of us as a team, we're taking input and guidance from a myriad of sources and people we respect very much to focus on data that really matters, not just a lot of headline media, but we're trying to manage these portfolios beyond the short-term market movements and really focus on the information that's important. So in summary, we're paying very close attention to many things, but we're making pragmatic, somewhat smaller changes to bolster each of our clients' portfolios, just in case there is a downturn. What we're not doing is we're not overhauling portfolios with big sweeping changes because there's maybe a debt ceiling showdown looming, which has happened before, or because there's an elevated chance of recession, which, by the way, is a natural part of the economic cycle. So the changes we're making to be prepared are more smaller and intentional versus overhauling anything. So that's what we're doing for you in these uncertain times. And if you're ever getting nervous, I wanted to leave you with one stat that I saw actually just yesterday. If you had invested $100,000, this is according to Morningstar, if you had invested $100,000 in the S&P 500 index 25 years ago, before fees, it would be worth approximately $310,000 as of March 15th. It's pretty good. Now, if you had missed only the 5 best trading days, only missed 5 days during that whole 25-year period, that same investment would be worth approximately $196,000. That's a difference of $114,000. You would miss out on approximately 1/3 of the return by missing only 5 days. And remember, the big up days and the big down days, those tend to get bunched together in clusters during pockets of volatility. So staying invested is very important. So if you have any questions about anything we've discussed here today, please feel free to reach out to me or to any of the advisors, and we will get you the clarity you need. Take care, everyone.